Okay, candle closures. Candle closures are one of the easiest ways to form a daily bias. This is easily one of the most important concepts to predicting the very next candle's direction. Blending candle closures with premium and discount and high time frame key levels is where things become very, very high probability. So bullish candle closures. Wick below a candle, right, and close within equals higher prices. Close above equals higher prices, right? Bearish candle closures, wick above equals lower prices, and close below equals lower prices. We want to blend this in context and framework with all the previous long-term perspective lessons. When we're blending all of these together, it becomes really, really high probability. Okay, so here's an example, right? We trade into a higher time frame key level here, right? That's in discount. We then close above, right? So we wick below and we're closing above the body here, right? This is an indication that the very next candle, right? And this is why I said we go candle by candle, because we're looking at the candle closures. So we wick below, higher prices for the next candle, then this next candle closes above the previous candle, which means higher prices for the next candle. Bearish example here. Higher time frame key level, we trade into it, we wick this candle here, right? So we wick above, we don't close above this candle, which suggests lower prices for the next candle. The next candle then closes below the previous candle, meaning even lower prices for the next candle, right? So when we're blending this candle closure technique with the other lessons, you're going to see just now how important it becomes in deriving the very next candle's higher time frame direction. Okay, going back to this example of the premium and discount, we had the relative equal lows with the monthly FVG. Notice here the candle closure, right? We wicked below this one candle here. What does that mean for the next candle? Higher prices, right? Okay, just going back to this example here, right? And then this candle right here, we close above, right? What happens? Higher prices. This candle closes above, what happens? Higher prices. This candle closes above, higher prices, until we reach a draw on liquidity. Now we look at this on a weekly time frame now. Notice with the order block, right? We wicked below, okay, and then closed above with one candle, right? Suggesting higher prices. We trade back down, confirming this as an OB. Market starts to trade higher, okay? Really important. And this is how we can now start blending it on the lower time frame, right? Which is a daily chart. We had that previous weekly low as a potential key level where price could reverse from. Then notice we were trading within this one candle, right? Now I'm not using just the previous day's candle here. Why? Because all of these candles, okay, are within this one candle. So when you have that scenario, then you do just use this one candle, because technically all of this is a consolidation and this is the main reference point. So notice here we wicked below, okay, this one candle. What happens next? Higher prices. We then close above, higher prices continuously, right? Till we get to that weekly OB. Once we get to that weekly OB, notice the market closes within the previous candle, okay? Market trades up higher. We form a volume imbalance, so another high time frame key level. We trade back down into it here. Do we close below? Right, so we don't start longing yet. We then trade below this candle here. Do we wick below? Yes, then we look for bullishness in the very next candle, right? So this is how it can save you, because if you had this mapped as a high time frame key level and you try longing it on this day, it doesn't work out, right? So if you want to build in a strong narrative and bias for the very next candle, you want to see that closure within to then tell you, right, the direction of the next candle with a higher degree of probability. Okay, another example here. We traded into the daily fair value gap here. We closed above the daily fair value gap here, confirming this as an OB, right? We then wick this candle here, okay? So we don't continue looking for longs. We also have a higher time frame key level defined by this bullish fair value gap. The market trades back down into the fair value gap here. We wick this one candle here, right? And why didn't we use this candle here? Okay, because this candle here wicked this high. Right, so we waited for this candle to get wicked. So we wick below, We then look for higher prices until we reach the opposing end of this one candle's range there. Okay. Then we trade to external here. Okay. And this is also, right, this is where you start incorporating the previous lessons, and this is how everything blends together. This is the low that caused the break of this high. It becomes an important key level. Market trades down below it. Wicks, right? It closes below the previous candle here. So we don't start looking for bullishness yet. When we wick this candle here and get that closure, we then know we're in a bullish delivery for the next candle, and we could have been looking for longs here during the equity open. Okay, and just going off a few more examples here to show you how effective and constant this is. This is not something that just happens a few times, it's every time, right? We then create this bullish expansion leg, higher time frame key level, price trades into the key level. We don't long yet because we don't have that candle closure. It closes below here. This candle then wicks and then higher prices, right? Till we get to the external range liquidity here. Then we have this one candle, right, with the high time frame key level is now this order block because we confirmed it here with the close above. So high time frame key level, market trades back down into it, running out this one candle's low. Do we wick below? Yep, that's the indication to trade to the opposing end of that candle and to have a bullish bias for the very next day's candle. Again, notice wick below. What happens next? We see a bullish expansion until we take out this high. We then wick this candle here, so we don't start looking for longs, longs. We then trade down again. We wick below, which means next day higher prices. Take out the swing high, so we're not trading above range highs. We wick above, so we don't long yet. We again trade above here. We have a fair value gap here after taking out external range liquidity, so it's likely to see the market trade back into internal. Daily fair value gap, high time frame key level. We trade into the daily fair value gap. We wick below. We start looking for high prices until we take out the external range liquidity. Okay, remember that low that broke the high lesson, buy side liquidity, that's our high time frame key level, 24,000 big figure, low that broke the high. We then trade up into the high time frame key level, the buy side liquidity, and we wick, right? This candle here, right? So we're suggesting lower prices. Now, a lot of people would be looking at this daily fair value gap and the wick here and thinking it's going to run higher. You can't do that because we are still wicking this candle here on this day. So as you go into the next day, you know you're looking for the low that broke the high, and this candle as well wicked this one candle. So it's still suggesting lower prices, okay? And we also have two volume imbalances overlapping. Another tip for your notes: when you see buy side liquidity taken and we're in a premium and the market has two overlapping, okay, volume imbalances, that's one of the strongest reversal signatures there is, okay? Anyway, wick below, lower prices, lower prices, lower prices until we take out the low that broke the high. Okay. Now we traded back down into a discount from this low to this high, right? We ran out this short-term low. We then create a bullish expansion, right? We're looking at the price to trade to that rejection block here on the weekly time frame, if you remember from the high time frame key level lessons. So as we trade into this daily fair value gap, we get a wick below, which is suggesting higher prices. So then we could long here, we close above the bodies here, we have another bullish day here till we trade into the high time frame key level.